Well, has the market bounce of the past few weeks that we have seen finally run out of steam? It's a good question. Welcome to Trading Nation. I am Brian Sullivan. Max Wolff of Manhattan Venture Partners and Stacey Gilbert of Susquehanna Capital are your guests today. Stacey, when you look at the options market, is it telling you that the run is done or maybe there's some more upside left?
Yeah, if there is upside, it is going to get there slowly. That being said, the downside really isn't being priced as a high probability. It's the next thing that's going to happen in the market. But overall, that sentiment there. So let's just look at 10% moves. That's, we've rallied almost 13% from our lows in February. 10% moves. So it's even less than what we've rallied recently. On the downside, it's around a 10% probability over the next 3 months. That's really not that atypical of what we've seen over the longer term and even over the last couple of years. It's the upside that's really disconcerting in the sense that the market is pricing in less than a 1% probability that we rally 10% over the next 3 months. This is actually extraordinarily low on a historic level. So it's not saying that we can't go higher, but the rally that we've seen, the likelihood that we see a similar type of rally in the coming 3 months is pretty low. The market says not happening. That being said, it's not really very, very, very concerned that we're going to have this immediate pullback to the historic levels that we had.
Sounds like you're just kind of saying we're going to be sitting at the bus stop for a while waiting, but the bus ain't coming. And we're not leaving.
Well, the truth is, exactly, because we're heading into earnings, and this is the big thing, and I know Max will talk on this topic as well. This is the big thing that the market needs. As we head into earnings, we need to see if there's any growth. This is part of what's been holding the market. We've gotten back to valuation levels that it's seen before. We're at this top of around 18.5 times PE. You need growth in earnings to really bust out of this level. Heading into earnings, I think it's going to be more stock-specific rather than broader market.
Okay, so Max, talk more to that topic, which is what you think is going to happen.
Yeah, so I'm not 100% sure this is the little train that could, right? I think the market wants it to get there. Maybe it's a little train that should, but should isn't could. So in our opinion, it's sort of, we're going to see bouts of real volatility and we're going to see it drift lower. I think the market's probably booked about 120% of the easy upside off those lows. So it got a little bit out over its skis. At about 18 to 19 times, we're at a sort of high end of a very boring range for multiple. The question is, are the earnings going to come down? And over the last 5 years, we've really seen the macro economy perpetually lag the ability of firms to be more profitable through global marketplace and also through cost cutting. We think that's pretty much run its course. So we don't think there's a lot of chance for corporate earnings to outperform macro. So macro's kind of sideways, not bad, but not great. So we see the markets drifting lower sideways with bouts of real volatility. I realize that's not the best sunny day picnic forecast out there, but that's our honest take on where we're going.
That's your take. Listen, I mean, everyone thinks it's sexier to say big gains or big crash ahead. I get that. It's the media, but at the same time, if that's what you see, that's what you see, right? Sometimes slow and steady maybe does win the race if you stay in the race, right?
Sure. You got to play or you can't win, right?
Yeah, perfect. Well, we had about 16 different sort of metaphors / conventional wisdom nuggets there. Max Wolff, thank you very much. Stacey Gilbert, thank you very much. Both saying not a lot's going to happen, but stay in the game. Guys, thank you. Trading Nation, we'll see you next time, everybody. We appreciate you tuning in as always. Take care.